This is the second part of our blog post on the VAT impact of finance transactions. So last month I covered bumping and online finance transactions. This month I'm going to have a look at the partial exemption and capital goods scheme implications of finance transactions. Again, I'm classing this as a red issue because the amount of adjustment to your VAT recovery due to the partial exemption rules can be substantial and unexpected. And the other issue you've got is that without professional assistance, it can be really difficult to actually mitigate these liabilities. The partial exemption rules operate to restrict the amount of VAT you can reclaim on your overheads if you're a partially exempt business. Now, if you're partially exempt, it means you have a lot of exempt income being generated within your organisation. So if I think about the typical dealer, the sorts of exempt income that I see is basically F&I and then potentially some VAT exempt rent as well. If this exempt income is 1% or more of your turnover in the period, then you'll fall within the partial exemption rules. Now, if you're a business that's got lots and lots of overhead VAT, then there are actually some additional rules as well, which I won't go into now, that would apply to you. So, if you're a partially exempt business, it means that you can't reclaim all of the VAT that you incur on your overheads within your organisation. The big problem is, though, that in this context, overheads also includes capital expenditure. So if you've just spent a load of money upgrading your showroom, potentially some of that VAT you've already reclaimed might actually have to be repaid back to HMRC. So if I think about a spend where it could be £1 million, for example, if your partial exemption percentage is, say, 5%, then due to the partial exemption rules, we're actually talking about a 10k cost on that project over and above all the rest of the costs that you've incurred. And that's without even considering any restriction there might be on recovery of overhead VAT that's gone through your P&L. So as you can see, it can be really costly. But it gets even worse, because if your project cost over £250,000 and it was a build, a refurbishment or a purchase of a property, you don't just look at the VAT recovery once. Due to something called the capital goods scheme, you've got to monitor the use of that property over a 10-year period, and there could be further adjustments that need to be made. So the adjustments would be triggered if, for example, you became more partially exempt, or perhaps you sold the property within that 10-year period. I can't emphasise enough how complicated these rules are, even for VAT advisors. So if you think you might fall within the rules, I think you really do need to speak to a professional to get a bit more advice about it. But what could you do now? What you need to do is have a look at your turnover and your results for last year and see whether your VAT exempt income was 1% or more of that turnover. If it was, or you think you might be increasing the amount of finance exempt income that you're generating this year, you need to then have a closer look at the partial exemption rules and the capital goods scheme rules to see whether they're going to affect you in a detrimental way. As I say, it's a very complicated area, so if you need any help reviewing your current situation, then please just let me know.